The biggest AI debt story on the internet right now says that 5 tech companies are hiding $1.65 trillion in debt. I read the actual filings and the number is real. The label is wrong. And the comparison underneath the headlines is even worse. But here is the part that nobody is talking about. One day after that story landed, Alphabet filed a new report that pushed the same rough calculations above $2.1 trillion. So the number got $500 billion bigger, and it still did not become debt. That sounds like a contradiction, but it isn't. And once you see what is actually happening, the risk is much more interesting than another AI is Enron headline. I work on Copilot at Microsoft and I evaluate AI platforms for a living. But everything in this video comes from public filings, and this is my own analysis, not Microsoft's. I'm not asking you to trust me because of where I work. I will show you what the companies actually signed and then ask the question that investors should have been asking from the start, not is big tech secretly bankrupt? The better question is, can these companies turn long-term infrastructure promises into durable, profitable usage before the hardware gets old and fixed payments catch up? Let's start with the $1.65 trillion. That figure can be reconstructed. Roughly $821 billion is signed leases that have not started. Think data centers that are still being built. The company does not control the building yet, and so the lease is not on the balance sheet. Another roughly $829 billion is purchase and construction commitments for chips, power, capacity, inventory, and construction. Add those together and you get $1.65 trillion. Those are real promises. Some are non-cancelable, and some contain minimum purchase requirements. Some are take or pay, meaning you can owe the minimum even if you do not use everything you reserved. So not debt does not mean optional, but it does not mean they borrowed $1.65 trillion and hid the loan. Debt is money received and owed back, normally with interest. A future lease pays after the delivery of a usable facility, and a purchase commitment pays after delivery of chips, power, capacity, or another service. There is something coming back on the other side of those contracts, and this is where the viral comparison really falls apart. The story compared the $1.65 trillion with roughly $1.35 trillion supposedly sitting on the company's balance sheets as debt, but that was total liabilities, not debt. It includes accounts payable, deferred revenue, taxes, compensation, recognized leases, and actual borrowing. For the reporting periods used in the original calculation, actual interest-bearing borrowing across the 5 companies were about $430 billion. Still huge, but a multi-decade stream of undiscounted payments was compared with every liability at one moment, and both were called debt. That is not a small wording problem. That changes the entire story. And Alphabet made the story stale almost immediately. The old calculation gave Alphabet about $408 billion of those commitments. Its next quarterly filing disclosed $811 billion in purchase and other contractual obligations, plus about $91 billion in leases that had not started. If we hold the other 4 companies fixed, the same rough methodology rises from $1.65 trillion to about $2.14 trillion. And that is why the viral label creates false predictions across different companies, dates, durations, and contracts. The headline is literally wrong. The underlying build-out is genuinely massive. But here's the structure that I actually care about. A lender or private credit fund finances a developer's data center project. The developer can borrow because a hyperscaler signed a long-term lease or a capacity contract. The developer is the one that's going to hold the loan, and the technology company is going to supply much of the economic certainty behind it. The technology company does not secretly take out the loan, but construction borrowing sits somewhere else, while the technology company is retaining those long-term payment guarantees and the backstops. So Alphabet's newest filing showed that $43.8 billion of credit backstop exposure, $7.6 billion in financial guarantees, and another estimated $24.1 billion of future backstops that are still subject to final terms. And Meta has disclosed a maximum exposure of roughly $46 billion around one unconsolidated data center venture. Oracle disclosed a facility where it guaranteed up to $3.3 billion of the lessor's borrowing. This narrower layer is where shadow borrowing becomes serious. Not for every dollar in the headline, contract by contract. And the correction does not make the financial pressure fake. Alphabet just reported negative free cash flow of $5.9 billion for the quarter, even while its cloud business grew 82%. And that combination is the whole debate. Incredible demand, incredible spending, and a widening argument about how long the returns will take.
Fixed income investors are demanding more reward to lend to these companies that have all raised their AI spending targets in the last few months and are on track to collectively spend more on Capex than they generate in free cash flow by next year. Mizuho writing this morning that investors are starting to ask where the limit is. And just today, the FT reporting that bond investors are requiring a 7.5% rate to finance Meta's 1 gigawatt data center in Texas.
The credit market is not treating this as a joke. The cost of financing these projects is part of the product economics now. Now, let me make the strongest case for these companies right now, because this is not a useful analysis if we only collect the scary numbers. The cloud providers also report enormous contracted revenue backlogs. Microsoft reported $627 billion. Alphabet, Amazon, and Oracle report hundreds of billions more. And Microsoft's AI business passed a $37 billion annual revenue run rate, growing 123%. Azure grew 40%. And Microsoft says that demand continues to exceed the available capacity. And Alphabet's cloud revenue just grew 82%. So these are not just like empty buildings that are financed against a dream and some zero customers. One infrastructure fleet can serve Azure and Microsoft 365 Copilot, GitHub, security, and internal models, and some of these OpenAI workloads. And Satya has made that point directly. He does not allocate capital to one Azure metric. He allocates it against the return for Microsoft as a whole. And that is a legitimate argument. And it's also a testable one. Satya's best defense of this spending is not that more compute is automatically good. It's that the software, the utilization, and the workload optimization can make expensive physical infrastructure produce more valuable outcomes. And I have seen this from the inside.
Whoever figures out that, oh, I can use tokens more efficiently for an outcome that matters in the world is going to get ahead, right? By definition. So then how does one build the intuition for it, right? Which is, this is where, what is that outcome? How do I measure it? What's the rubric? In fact, this is where I think the evals, if it's fascinating. How much time needs to be spent, especially for an RL regime? I think it's been the clearest, where if you really want to set up the rubric and the eval dimensions or the rubrics scoring dimensions such that they're really capturing the high taste that you only can define. Because if you did that, then you could be token efficient.
And that is the right standard, right? Do not show me how many graphics processors you bought. Show me what customers can now produce with it, how much cheaper it became, and whether they keep paying to do it again. Because this is the problem. Future revenue backlog and future spending commitments are not the same thing. They're not mirror images. Commitments can be non-cancelable, take or pay, span 15, 20, or even 30 years. But backlog has different durations, cancellation terms, margins, and customers. It is revenue before delivery costs. Some large contracts also sit in an ecosystem where the cloud provider may be an investor, a financier, the supplier, or a revenue share partner, like in the case of OpenAI. You cannot just subtract one giant number from the other and declare the risk covered. Microsoft is a good example of why it deserves, I think, a more sophisticated approach. Last quarter, Microsoft spent $31.9 billion on capital assets. Roughly 2/3 went to shorter-lived assets, mainly GPUs and CPUs. Quarterly depreciation rose to $9 billion, which was a 55% year-over-year increase. Microsoft's cloud gross margin was 66%, partly pressured by AI infrastructure and usage. And $1 billion of processors and $1 billion of concrete are not the same bet. One can become outdated within a model cycle. The other may serve several generations of hardware. So yesterday's capital spending becomes tomorrow's depreciation expense, even after the excitement moves on. So instead of asking whether this is Enron, I want companies to answer 3 much better questions. First, how much future spending is truly non-cancelable or take or pay? And when does it come due? Second, how much contracted revenue comes from diversified, independent customers, and how much is concentrated in a small group of strategic partners within that same ecosystem that I was talking about? Third, what return are customers producing from this compute after depreciation, energy, hardware replacement, and the full cost of serving the workload? That's the dashboard that I want as an investor, but it's also the dashboard that I would want as a product leader deciding whether AI is creating value or just moving money around the ecosystem. So no, big tech did not secretly borrow $1.65 trillion. The contracts were disclosed. The accounting is very ordinary, and the Enron comparison genuinely is lazy. The risk here is real. and it is moving through long-term leases, purchase commitments, project financing, guarantees, hardware depreciation, and a small number of enormous counterparties. If AI demand is durable, and these backlogs look like it's very durable, this could become the most important infrastructure build-out of our lifetime. If the returns disappoint, the first cracks may not appear in a chatbot. They may appear in the contracts underneath it. Because the question is not whether these companies can spend $2 trillion. The question is what the rest of us get back. If you like the content, please don't hesitate to subscribe, leave a like, and comment. Peace.